Okay, let's dive right into this explainer. Today, we're deconstructing the hidden, honestly fascinating mechanisms of a massive national bureaucracy. Most people look at the administrative state and just see a random, boring collection of red tape. But today, based on some really extensive expert analysis, we're going to treat this vast system completely differently. We are going to look under the hood and analyze it as a highly calibrated living engine. How does it actually work? Let's find out.
So here's the big question. How does a modern state systematically enforce compliance across physical borders, economic markets, and global jurisdictions? Well, by analyzing these totally disparate parts as a single interconnected operational engine, we can uncover the true cause and effect relationships governing our society. As outlined in recent expert reports, we have to look way past the surface level politics and storytelling. We need to focus entirely on the mechanics. The implicit assumption driving this entire machine is actually pretty simple. Absolute control requires absolute visibility.
All right, Section 1, maintaining the boundaries, physical and civic.
To really understand state administration, we have to first look at the extreme edges of the system. Notice how clearing physical brush for visual security serves the exact same systemic function as rigorous address updating rules. They're two sides of the same coin. They both eliminate blind spots. On the physical border, enforcement relies on clearing heavy brush to maximize the efficacy of cameras and sensors. But on the civic side, immigrants interacting with tribunals must submit an address change within 5 days of moving, or they instantly default in the system. So whether it's literally cutting down trees or updating a mailing address, the underlying mechanism serves one specific goal: guaranteeing a rapid administrative response. And before granting full access to this civic system, a binding commitment is absolutely required. Now, this isn't just some ceremonial act. This implicit assumption of loyalty acts as the ultimate civic contract. It establishes a firm baseline of meritocracy and the rule of law, which legally justifies all the systemic compliance demands that will be placed on participants moving forward. Moving right along to Section 2, Economic Architecture and Jurisdiction.
Now, let's move inward to the economic hubs. The highly non-obvious reality of modern jurisdiction is that an economic nexus can suddenly make you liable for local taxes, even if you've never set foot in the state. Historically, something like attending a trade show triggered a physical nexus, but modern compliance analysis reveals a massive structural shift. Simply selling a certain volume of digital goods into a jurisdiction creates an economic nexus. You are captured by the system's matrix purely through data and sales volume, completely erasing the need for physical borders. It's a real game changer.
Let's expand on this cross-border architecture for a second. You might have a corporate structure located in a jurisdiction with zero local operations, effectively serving as a legal tax haven. Now, you might think, why on earth does the system allow this? Well, it's a highly calibrated trade-off. The system trades zero tax revenue for absolute informational visibility. While the foreign-owned holding company pays literally no income tax, the mandatory informational returns it files are vital mechanisms the state uses to aggressively trace and monitor global financial networks. And this number right here, the $600 threshold, highlights a massive systemic shift. Historically set at $5,000, the threshold for reporting digital payments dropped drastically. Why? To heavily monitor the rapidly expanding gig economy. Think about what this means on a practical level. If you use a third-party payment app or sell some freelance services on the side, the reporting net is now cast incredibly wide. The administrative engine has turned nearly every microtransaction into a highly visible data point.
Let's transition to Section 3. The global taxation matrix. So, how does a government avoid double taxing its citizens who are operating abroad? It does this through the meticulous machinery of foreign tax credits. But here's the thing: timing is absolutely everything. Most individuals use the paid method. Cash leaves your hand, you claim the credit. Pretty straightforward, right? Multinational entities, however, often use the accrual method. claiming the credit the moment the liability is legally fixed before cash even moves. But according to expert documentation, once you choose the accrual method, you generally cannot go back. You are permanently bound to that operational logic, fundamentally altering your entire global cash flow. And to actually claim this foreign tax credit, a tax must meet 4 extremely rigid tests. It must be an actual income tax, meaning you can't receive a specific economic benefit in return. But the absolute most critical hurdle is test number 3. It must be a legal and actual liability. Basically, the domestic system won't subsidize you giving up too easily to a foreign authority. You are forced to exhaust all practical foreign appeals to ensure you're fighting for the exact legally required rate. International tax treaties are essentially designed to cap statutory rates. But if you fail to invoke that lower treaty rate, the excess withheld cannot be claimed as a credit. Let me put that into perspective. If a treaty says the withholding rate is 15%, but the foreign country took 20% just because you didn't file the right paperwork, well, that extra 5% is your problem, not the state's. The administrative engine demands absolute precision from its participants, no exceptions. Okay, Section 4, Deep Compliance and Due Diligence. The system relies heavily on tax professionals as its first line of defense, particularly in the gray areas. A practitioner must deeply interrogate a client's narrative. A perfect analytical example of this revolves around the declaration of gifts and inheritances received from abroad, which is specifically enforced through Form 5320. Imagine a taxpayer inherits funds held in a foreign bank account, but they totally fail to mention it because they just don't realize it's important. The practitioner's due diligence legally requires them to ask probing questions to uncover these hidden foreign assets and ensure Form 3520 is actually filed. It is an active, mandatory duty to uncover the invisible, or they face severe penalties themselves. Now, in very rare instances, the bureaucratic engine actually bends its own rules of chronological time. If a federally declared disaster destroys property, you don't have to wait to file your current year's return. The system allows you to amend the preceding year's return to claim the loss retroactively. This is an incredibly powerful, non-obvious mechanism where the state deliberately prioritizes speed over standard sequencing to immediately inject capital back into a damaged economic zone. It's fascinating how the system adapts when it absolutely needs to. Moving to Section 5, the ethical guardrails. So, what happens when the drive for absolute compliance collides head-on with professional ethics? Here is a highly non-obvious detail found in the expert reports. Tax practitioners are strictly barred from unilaterally fixing a client's error without consent. You would naturally think the system just wants the data fixed at all costs, right? But no. If a professional spots an error on a past return, they must advise the client to fix it, but they absolutely cannot file an amended return behind the client's back. Prioritizing legal confidentiality actually overrides immediate state compliance. Furthermore, the system literally quantifies professional confidence. Practitioners must heavily scrutinize their own advice, ensuring there is a statistically reasonable basis for every single claim to protect their operational license. If a tax position doesn't have at least a 25% possibility of surviving a systemic challenge, the professional is legally forbidden from recommending it. This rule essentially serves as a built-in algorithmic safety rail for the entire compliance industry. Finally, let's wrap up with Section 6, Systemic Checks, Balances, and Resolution. Look, no engine runs perfectly all the time, so there must be independent mechanisms for repair. When regular customer service completely fails to resolve disproportionate penalties, the system provides a precise, hard-coded escalation architecture. It deliberately bypasses standard dead ends by offering an independent advocacy office and an ombudsman. These aren't just polite help desks. They are legally empowered override switches. They can suspend aggressive collection actions or even force a high-level executive review when standard algorithms mistakenly flag a perfectly compliant business.
And there is a massive analytical difference between saving a single business from an error versus rewriting the system's operational code to protect everyone. Resolving one individual's penalty is helpful, sure, but the true systemic value of these advocacy groups is identifying deep structural flaws. If 50 businesses are penalized for the exact same incorrect reason, the Ombudsman doesn't just go in and fix 50 accounts. No, they force the agency to fundamentally change its underlying administrative programming.
So we've seen how physical brush clearing directly mirrors data tracking. We've seen how foreign tax credits demand the total exhaustion of international appeals, and how practitioner due diligence actively unearths hidden global assets like we saw with Form 3520. This leaves us with a really profound question regarding the design of our administrative frameworks. How can a bureaucratic system possibly balance the strict, unforgiving demands for absolute visibility with the absolute necessity for independent fairness? It is this exact delicate tension that keeps the machine from breaking down completely. Thank you for joining me on this explainer, and remember to keep questioning the hidden engines operating all around you.